So if they revalued the gold certificates to, let's say, $3,400, that would be that would be about 800 billion in profit for the Treasury, and they would have to write new certificates for the Fed at 3,400, and the Fed would send the profit to the Treasury, and they could use that to do whatever they want to. So if you revalue it to 15,000, I mean, that's a much bigger number. I think Clive came up, I don't know how much it was. So that's about four times. So it's about 4 trillion. If you do it to 30,000, that's 8 trillion.
One possibility now emerging in global policy circles is the use of valuation gains on gold reserves, a strategy recently proposed in both the US and Belgium. For the US, this would mean revaluing the government's 261.5 million troy ounces of gold, the most prominent reserve position in the world, from the outdated statutory price of $42.22 per ounce to current market levels near $3,300. Mario Innecco, widely recognized for his expertise in monetary economics and financial markets, points out that such a move could dramatically reshape the Treasury's balance sheet. If gold certificates were revalued to $3,400, the Treasury would instantly gain about $800 billion, with new certificates issued to the Federal Reserve and the profit transferred back to the Treasury. Pushing the valuation to $15,000 would generate roughly $4 trillion, while a $30,000 price would yield around $8 trillion in windfall gains. The numbers are staggering, but the underlying mechanics are rooted in history. Innecco explains that the U.S. Treasury's 8,133 metric tons of gold are matched by gold certificates held by the Federal Reserve, a structure dating back to 1933 when President Roosevelt outlawed private gold ownership and centralized the nation's bullion in Treasury vaults. On paper, these holdings are valued at just $11 billion, a figure that has remained unchanged since the last revaluation in 1973, even though their market value today exceeds $500 billion. This gap represents one of the most significant hidden assets in the U.S. financial system, an undervaluation that, if addressed, could bolster the nation's fiscal position almost overnight. In this video, we examine the reasons behind this accounting discrepancy, the potential impact of a revaluation on the dollar and debt markets, and why such a move could not only inject immediate liquidity into the Treasury but also establish a new price floor for gold. And as history shows, once gold's official price rises, it rarely, if ever, comes back down. So keep watching, and if you appreciate in-depth, data-driven analysis of the financial system, don't forget to like this video and subscribe to the channel for more weekly insights. Your support means a lot, and we hope you enjoy the content.
What the Dow-Gold ratio reveals, in my opinion, is the preference for gold or real money versus paper assets, and that's what it really implies. The fact that it's been going down since then, of course, it hasn't been going down in a straight line, says that more and more confidence is being lost in financialization and paper assets. And the gold is the premier, let's say, indicator of hard assets and real things. So that's what I think it's implying. And I think, a reset is a correction. So if we price stock market in terms of the Dow, even the S&P in gold since the beginning of the century, they've actually been losing real value. And I think they're going to continue to do so. And unlike, let's say, an overnight reset, which happens when governments and central banks adopt a policy, let's say, over a weekend, the reset I'm talking about is more gradual, of course. And a lot of people have lost out, in my opinion, because they've been in paper assets, and I'm not saying they haven't done well, but I think being in gold is very safe, and it's done a really good job since 1999. The U.S. Treasury officially has 8,133 metric tons of gold, and the Federal Reserve has gold certificates that are claimed to that gold. And the reason that happened was back in 1933 when Roosevelt he took in all the gold. He made gold illegal, and people had to hand in their gold and take Federal Reserve notes for it. All the gold came through the Fed regional banks, and then the Fed regional banks gave the gold to the Treasury, and the Treasury issued these gold certificates. And that was at $20.67. And then in 1934, they came out with the Gold Reserve Act in January 30th, I think, 1934. And that day they revalued gold to $35. And the Fed sent the profit to the Treasury because the gold was taken in at $20.67. And the revaluation, they sent the profit to the account of the Treasury, and they kept those certificates. And then in 1972, after Nixon closed the gold window, the Congress revalued that price from 35 to 38 because, the international price of gold was going up. And it didn't make sense to have the price at 35. They revalued it again in 73 at 42.22. And by then, gold was almost at 100. So they're always late, but they haven't revalued it since then. So all that gold and the certificates at the Federal Reserve are worth about $11 billion. So if they revalued the gold certificates to, let's say, $3,400, that would be about $800 billion in profit for the Treasury, and they would have to write new certificates for the Fed at $3,400, and the Fed would send the profit to the Treasury, and they could use that to do whatever they want to. So if you revalue it to 15,000, I mean, that's a much bigger number. I think Clive came up, I don't know how much it was. So that's about four times. So it's about 4 trillion. If you do it to 30,000, that's 8 trillion. So they could choose any number. But the thing is about revaluing, and we saw the other day, Alexei, that even the Federal Reserve Board now, on August 1st, they published an article about how this process works, and they'd never done that before. So are they preparing to do a revaluation? I don't know. It's just speculation. But if they revalued it to the market price right now, let's say 3,400, yes, they'd have an extra 800 billion, the Treasury. That would help them. But what it would do, it would put a floor under the gold price. Because back in 73, when they revalued it to 42.22, we never saw that price again. And by 1980, the price of gold had gone up to like almost 900. So it would be, even if they revalued it to 3,000, for example, it would be very bullish. They might want to do it a little more than the current market price, maybe because they might want more profits for the Treasury. They might just let the market keep going higher, and then maybe in 6 months to a year announce it, let's say at 4,500. Or they could announce it over the weekend at 10,000, and that would basically close down the gold and silver market probably for a week, because things would just go crazy. I don't know what would happen, and that's why I tell people it's better to be early than one day late, and that's why I say, you need a little bit of physical gold and silver.
Mario Innecco highlights that a U.S. gold revaluation would have major global effects, benefiting countries like China, Russia, and European nations with large bullion reserves. He points out that foreign investors hold about $8 trillion in U.S. treasuries, over 20% of total debt. As of August 8, U.S. national debt had reached $36.99 trillion, up $45.7 billion in a single day, compared to $907 billion 40 years ago. Projections from the Congressional Budget Office warn it could climb to $54 trillion within a decade, driven by an aging population, rising healthcare costs, and the impact of higher interest rates, underscoring the urgency of addressing America's mounting fiscal challenges. At the same time, central banks are rewriting the playbook for reserve management. The World Gold Council reports that official sector purchases hit 166 tons in Q2 2025, a 41% increase above historical averages, pushing global central bank gold holdings to more than 36,000 tons. This wave of accumulation isn't merely about price speculation. It reflects a deliberate diversification away from USD-denominated assets and a strategic pivot toward tangible monetary anchors. The result is a structural underpinning for gold prices and a clear signal of a broader transition toward a multipolar monetary order, where gold plays a far greater role in the global financial architecture than it has in decades. Let's get back to the interview.
One thing is that a lot of countries now, especially China and Russia, they've been buying a lot of gold. They would do very well as well. So would European countries that have a lot of gold. In terms of the debt, if you look at the debt owed to foreigners, treasury debt is about 8 trillion. So that would be, how can I say, just over 20%. And even during the 19th century, when there was a gold standard, countries like Britain, they kept like a 33%, 30% gold cover. So yeah, it might not sound that much, 8 trillion out of 37 trillion in debt, but a lot of people argue that the gold cover should be more related to the money supply, i.e. M2, and M2 is around 22 trillion, so 8 trillion wouldn't be that bad. I would say it would be like a 40% cover. And when the Fed was created, or back in the 30s, they used to have a 40% cover. Every Federal Reserve note needed to be 40% backed by gold. So I don't think it would be a problem. And I guess if the U.S. did this every 5-10 years, this revaluation, then yeah, they would lose credibility. In the millennium, I guess, 1,000 years. Because I looked at this chart from Charts R Us, and they had the gold price since the 1200s. And yeah, it goes steadily up, which means the nations or the kings and queens, they debase the gold, through wars and stuff. But then you look at the 20th century and World War I, World War II, and especially after 1971, and the price of gold is like a hockey stick, and something that never happened before. And yeah, that's the situation we're in because, well, prior to, let's say, World War I, when there were major wars, for example, the Napoleonic Wars, there was inflation here in the UK because they suspended convertibility of the banknotes into gold. But after the war ended, they went back to gold. Yeah, I think we are late in the day, and some people might argue, well, if they were manipulating the price of gold, how come it's gone up so much? But I think that wasn't really the point when you look at the fact that the gold contract on COMEX was created on December 31st, 1974. And that date is important because on January 1st, 75, gold was made legal again in the U.S. And there's some WikiLeaks documents from 1974 where U.S. State Department and Treasury officials, they communicate, correspond with bullion dealers in London, and they say we need to do something about this because we don't want the public to go and start hoarding physical gold. So the dealer said in London, yeah, that's right. And he said, the dealer said, by creating a liquid futures market that will negate that physical demand because the futures market is leverage and it will like mushroom the whole physical market, and it will keep the market volatile, the prices, and it will put off the public. So that's how they do it. But now you have central banks, non-Western central banks, accumulating gold hand over fist since 2022. And they don't buy futures, they buy the real thing. And that's making it harder and harder for this paper game to continue. And even on the LBMA, which is supposed to be a physical market, a lot of their trading is through OTC promissory notes. But when someone wants to take delivery, especially a big delivery, and regularly, it spoils the whole game. And the central banks, they say, oh, we don't trade futures or gold, but the BIS does. And the BIS, who are the BIS's clients? Well, they're central banks. So I think that's how they hide it. But the bullion banks as well, for themselves, it's not very regulated market, because the bullion banks, they trade gold and silver. It's in the foreign exchange market. Most people don't know that. Gold and silver are traded as a currency. So they front run a lot of times, probably orders from the BIS, because they know it's a big pocket, big order. So yeah, it's a bit of both, I would say. There probably will be like no gold and silver for a while at any price, because no one will know. And the dealers, the bullion dealers, will have a really difficult time, and they won't want to give a price because there's no idea. But it will be a lot higher. Yeah, I think people need to maybe get used to pricing things in grams of gold and silver, or ounces, having an idea, because when that happens, what you said, I think there won't be any more paper dollar, paper euro, or paper pound or yen. The system will really have broken down. I think they are trying to take us into a world where it's very easy to transfer financial assets, gold included, through tokenization. Yeah, I mean, I would be a lot more comfortable, for example, if there were a token where you can buy gold or sell gold or transfer gold. I would be comfortable if I could go to a bank and say, I want my physical gold. I want to know that it's there, because it's difficult to trust at the end of the day, if you trust any institution. So yeah, I wouldn't put all my eggs, or all gold or silver, through a tokenized system. I would still keep some physical.
Mario Innecco's analysis points toward a global financial system approaching a historic inflection point. Structural weaknesses, such as mounting debt burdens and diminishing trust in fiat currencies, are aligning with a reorientation in reserve management strategies. Policymakers and institutions alike are increasingly favoring tangible assets over paper-based instruments, marking a fundamental rethinking of stability and value preservation. This shift is not just a short-term hedge against uncertainty, but a deeper, systemic recalibration of global financial priorities. As these trends gather momentum, the consequences will extend far beyond precious metals. Adjustments in official asset valuations and reserve compositions have the potential to redirect capital flows, influence global market behavior, and reshape perceptions of economic strength. Innecco's perspective suggests we may be entering an era where multipolar, asset-backed financial systems replace the long-standing dominance of purely fiat-based frameworks, ushering in lasting changes to the balance of monetary power worldwide. What if the financial system is already in the early stages of a historic transformation, and most investors haven't realized it yet? If you found this breakdown valuable, make sure to like the video, subscribe, and share it with other serious investors who need to hear this. We'll continue to bring you the smartest minds in the markets and the insights to stay ahead of the storm. Thanks for watching.